Yesterday, the European currency failed to resume its bullish run despite buyers' restless attempts to push it up. By late trade, the euro came under pressure again. Statistics on consumer confidence in the euro area turned out to be disappointing. Data also showed that Germany's inflation cooled slightly in November. Later on, the United States reported data on consumer confidence. The indicator remained unchanged from October, thus meeting analysts' forecasts. As a result, demand for the US dollar recovered. This helped the market find equilibrium. Today's macroeconomic calendar is full of important releases, including a speech by Fed Chair Jerome Powell. Notably, investors latched on to more hawkish remarks of his colleagues earlier in the week. They started talking about the need to further raise interest rates. The likelihood of coming large rate hikes triggered a sell-off in the stock market, a rally in the dollar, and a decline in risky assets such as the euro and the British pound. If Jerome Powell takes the same stance in today's speech, growing pressure on the euro will force investors to lock in profits. In this case, the European currency will suffer heavy losses. In addition, traders may take notice of data on Germany's unemployment rate and the number of people out of work. The euro area is set to release statistics on consumer prices. Eurozone inflation figures for November are expected to show price rises edging down to 10.4% year-on-year from a record 10.6%. If the reading is in line with forecasts, the euro will come under stronger pressure. After all, if inflation shows signs of cooling, the need for the European Central Bank to stick to its aggressive rate hike path will diminish. Besides, it's worth paying attention to the ADP National Employment Report. Economists expect US non-farm payroll to add only 200,000 after rising by 239,000 a month earlier. This may weigh down on the greenback. A slowdown in the pace of job growth will signal an inevitable recession in the US, thus pointing to economic pain from the Fed's aggressive monetary policy. Furthermore, traders may make a point of data on US GDP growth. The economy is anticipated to grow at a 2.7% pace in the third quarter. As I noted above, the focus of market participants will be on Jerome Powell's speech. If he confirms the regulator's intention to remain abrupt and aggressive with interest rate increases, the US dollar will most likely rally at the end of this month. If there is a shift in Powell's tone coupled with weak data on GDP and the US labor market, the euro may well hit 1-month highs. And now let's move on to technical analysis and consider the euro-dollar pair's dynamics on the 1-hour chart. Today is likely to be marked by increased volatility. I recommend that sellers focus on the level of 1.0376. A false breakout at this mark will create a strong sell signal. In this case, the euro will slide to 1.0320. If the price breaks through this level and tests it from the bottom up, the volume of short positions will increase further. Thus, the euro will plunge to 1.0271 and 1.0224. At the level of 1.0224, it would be a wise decision to buy the pair on a rebound with a view to catch an intraday correction of 35-40 pips. Long positions at 1.0320 and 1.0271 can be considered only amid a false breakout. If the euro breaks above 1.0376 and tests this level from the top down, it will be possible to go long, especially amid upbeat statistics from the euro area. In this situation, the European currency will have a chance of rising to 1.0430. In case comments from Fed Chair Jerome Powell are seen as dovish, the pair may even surge to 1.0490. At this mark, I recommend opening short positions on a rebound, counting on an intraday correction of 35-40 pips. Going short at 1.0430 will be relevant only in the event of a false breakout. Speaking of the British currency, the situation is quite similar. A false breakout at 1.2020 will create a sell signal, thus dragging the pound sterling down to 1.1944. If the price breaks through this level and tests it from the bottom up, an additional sell signal will be generated. In this case, the pound-dollar pair is expected to dip to 1.1878 and 1.1820. At the mark of 1.1820, traders may go long on a rebound. Long positions at 1.1878 and 1.1944 can be considered only amid a false breakout. Alternatively, if bulls are able to regain control of 1.2020 and test it from the top down, it will be possible to add long positions. Thus, the British pound will most likely advance to 1.2102 and probably 1.2179 following Powell's speech. At the level of 1.2179, I recommend going short on a rebound, counting on an intraday correction of 45-50 pips. Short positions at 1.2102 will be relevant only in case of a false breakout. Good luck.